Most people spend their entire lives stuck in the same financial loop. Wake up, go to work, get paid, spend the money. Then start all over again next month. Decades pass, and somehow the bank account never really changes. But here's the surprising part. Some people escape this cycle incredibly fast. Not because they earn millions, not because they win the lottery, and definitely not because they got lucky. They simply follow a system that quietly turns every paycheck into something far more powerful. A growing portfolio, and once that system starts working, money begins to behave differently. Instead of constantly leaving your hands, it starts multiplying in the background. But before that transformation happens, there's one invisible trap that keeps most people stuck forever, and almost nobody talks about it. The paycheck trap doesn't look dangerous at first. In fact, it feels normal. You earn money, pay bills, buy things you need, maybe enjoy a few rewards for your hard work. And by the time the next paycheck arrives, most of the money is gone. Then the cycle repeats. For millions of people, this becomes a lifelong routine. And the strange thing is that even when income increases, the problem often stays exactly the same. A raise comes in, spending rises to match it. A better job appears, expenses quietly expand again. This phenomenon is often called lifestyle creep, and it's one of the biggest silent killers of wealth. Instead of getting ahead financially, people simply upgrade their lifestyles and remain stuck in the same position. But the real issue goes deeper. Many people believe investing is something only the wealthy can do. They imagine huge sums of money, complicated financial strategies, and experts in expensive suits managing portfolios worth millions. So they wait. They tell themselves they'll start investing someday, once they earn more. But that someday rarely arrives, because the truth is far simpler. Investing isn't reserved for the wealthy. It's simply the act of putting money into assets that grow over time. And escaping the paycheck trap starts with a small shift most people never make. There's a rule used by countless financially successful people, and it sounds almost too simple. Pay yourself first. Most people treat investing as something optional. They pay bills, they spend money, they handle responsibilities. And if anything happens to remain at the end of the month, they might save a little. But wealth builders reverse this order completely. The moment income arrives, a portion of it is set aside immediately, before spending begins, before lifestyle expands, before anything else touches the money. It's treated like a non-negotiable bill, except the payment goes directly toward their future. Some experts suggest saving or investing around 10 to 20% of income, but the exact percentage matters far less than the habit itself. Because once the system is established, something powerful happens. Investing becomes automatic. No constant decision-making, no emotional debates, just consistent progress. But here's where many beginners make a critical mistake. They believe saving money alone will build wealth, and that assumption quietly slows their progress for years. Saving money feels responsible, and to be fair, it absolutely has a role. Emergency funds, stability, and short-term goals all rely on savings. But when it comes to building long-term wealth, simply storing money in a bank account has a hidden weakness: inflation. Every year, the purchasing power of money slowly decreases. Prices rise, goods become more expensive, and cash sitting still quietly loses value. This means someone could save diligently for years, yet still find their money buying less than it once did. Investing solves this problem by putting money to work. Instead of sitting idle, it begins generating returns. Those returns generate more returns, and over time, something remarkable begins to happen: compound growth. Compounding means earnings begin producing their own earnings. The effect starts slowly, almost unnoticeably, but as time passes, the growth curve begins to accelerate dramatically. What begins as small monthly contributions can eventually transform into something far larger. But smart investors rarely jump straight into the market without preparation. Because before money starts growing, there's one protective step that prevents disaster. Imagine investing money and suddenly facing an emergency. A medical expense, a job interruption, a major unexpected bill. Without a financial cushion, many people are forced to sell their investments immediately, sometimes at the worst possible moment. This is why experienced investors build a safety net first: an emergency fund, typically covering several months of essential expenses. This cushion protects investments from sudden disruptions. It allows money in the market to stay invested, even during life's unpredictable moments. And once that foundation is in place, the real transformation can begin. Turning a paycheck into a portfolio, the word portfolio often sounds complicated, but the concept is surprisingly simple. A portfolio is just a collection of investments. These might include stocks, funds, bonds, or other assets that grow over time. One of the most popular starting points for beginners is something called an index fund. Instead of betting on a single company, index funds track entire markets. This spreads risk across hundreds of companies at once. If one company struggles, others may perform well. This balance is known as diversification. It's one of the most powerful tools investors use to protect and grow their money. But even with the right investments, many people still struggle with consistency. They invest sometimes, skip months, then try to predict the perfect moment to enter the market. And ironically, that strategy often causes more harm than good, which is why experienced investors rely on something far more powerful: automation. Automation removes the biggest enemy of investing: emotion. Instead of guessing when to invest, money moves automatically from paycheck to investments. Every week, every 2 weeks, or every month. This approach creates something called dollar cost averaging. Money enters the market consistently, regardless of whether prices are high or low. Over time, this smooths out market volatility, and more importantly, it builds discipline without requiring constant attention. The system simply runs quietly in the background while life continues. But something even more interesting happens once this routine continues long enough. Momentum begins to take over. At first, the numbers may seem small: a few $100s invested, then a few thousand. Growth might feel slow, almost invisible, but as time passes, the pace begins to change. Returns generate additional returns. The portfolio expands faster each year, and eventually, investment growth may begin rivaling or even surpassing the money being contributed. This is the moment many investors describe as a financial turning point, because wealth is no longer dependent solely on a paycheck. The portfolio itself begins producing growth. But the final shift that separates ordinary earners from true wealth builders isn't just about money, it's about identity. Most people spend their lives as consumers. They work hard, earn income, and exchange that income for products and experiences. There's nothing wrong with enjoying the results of hard work, but investors think about money differently. They focus on ownership. When someone buys shares of a company, they're not just buying a ticker symbol. They're owning a small piece of that business. If the company grows, their ownership grows in value. If the company succeeds, their wealth grows alongside it. This simple shift from consumer to owner changes how money flows through life. Instead of constantly leaving your hands, money begins returning with reinforcements. And the more consistently that system runs, the stronger it becomes. Turning a paycheck into a portfolio doesn't require genius. It doesn't require perfect timing, and it definitely doesn't require millions of dollars. The process is surprisingly straightforward. Earn income, set aside a portion automatically, invest consistently, allow time and compounding to do their work. What begins as small contributions can slowly evolve into something powerful: a portfolio that grows quietly in the background. A system that works whether you're watching it or not. And the biggest risk in this entire process isn't market volatility or picking the wrong investment. It's waiting too long to begin, because every year spent delaying the journey is a year compounding never had the chance to work. And the sooner the system starts, the sooner your paycheck stops being just income and starts becoming the foundation of real wealth.